A very good evening to class 12 students. I'll continue with the chapter on financing, and today I'm going to discuss with you the factors affecting capital structure. In my previous session, I discussed with you the meaning of capital structure. This is an important question for the boards. Factors affecting capital structure. Okay, factors affecting the capital structure of a business. So first factor is exercise of control. Now, exercise of control basically means the promoters of a company, the founders of a company who formed the company, if they are of the view that they want to keep the control of the company in their own hands, then they should be keeping or retaining majority of the equity shares with themselves, because equity shares carry voting rights. By doing so, by keeping majority of the equity shares in their own hands, they would be acquiring and retaining the majority of the voting rights, and they will exercise a control regarding choosing who will be the regarding electing the directors of the company. Okay, now with due course of time, the company would be needing more funds. So such a company where the promoters are of the view of retaining the control in their own hands, such a company is called closely held company. What should they do to raise more funds? What should they do to collect more money? They should not be issuing equity shares, rather they should be issuing preference shares and debentures, for the simple reason that preference shares don't carry any voting rights. Whoever is going to purchase the preference shares is not going to get the voting rights. Similarly, debentures, whoever is going to purchase, he will not be acquiring the voting rights. Therefore, the preference shareholders and debenture holders will not be having any control, will not be having voting rights, and hence the control of the promoters who hold the majority of the voting rights will not get diluted. Are you getting it? But if they want to keep the control, and with due course of time they need more funds, and what they do is they issue equity shares, then obviously the new shareholders, the people who acquire these shares will also acquire the voting rights. So what will happen? In like earlier, the control which original promoters were having, they now the new shareholders are also having the voting power, so they will also have a say. So what is going to happen? The control of the promoters is going to get diluted. I hope the idea is clear. So in nutshell, the the companies where the promoters want to keep the control in their own hands, okay, they should try to keep majority of the equity shares with themselves, and in future, whenever the company needs more funds, they should raise the funds by issuing preference shares or debentures. Point number two: need for flexibility. Need for flexibility. Flexibility. Children, capital structure should be flexible, just like we talk about fitness, the human body should be flexible. So capital structure should be flexible in the sense, uh, whenever the company needs money, it can issue these securities and raise money, and whenever later on the company thinks that it doesn't need that extra money, it can refund. Such a feature is present in the case of preference shares and debentures. So, in short, preference shares and debentures make the capital structure flexible. Why? What is the reason? Whenever the company needs funds, it can issue preference shares and debentures, and later on, after a few years, when the company thinks that the directors feel that the company doesn't need these funds, they can refund, they can redeem the preference shares, and they can redeem the debentures. But in the case of equity shares, what happens? Whatever money is collected by selling equity shares is called equity share capital, as you know. That money remains with the company forever. Only when the company is going to wind up, when the company is going to shut down, in that scenario, the company has to refund that money to the equity shareholders. So, equity share capital is permanent capital of the company. So it makes, you can say that it adds rigidity to the capital structure. But preference shares and debentures add flexibility to the capital structure. Now there's a another condition to it. Whenever a company is formed, initially no company will issue debentures or preference shares. Initially, in the starting, the company has to issue equity shares. It's going to happen only later on, at a later stage, that the company is going to can issue preference shares and debentures. I hope this is clear. We move on to the third point, third factor, and that is nature of business, on which the capital structure of a company, of a business depends. Nature of business, children. Okay, now I'll just read out, then I'll explain. Companies with regular and high profits. Companies with regular and high profits can borrow more debt. Okay, see, business nature also varies. There are some business firms, there are some businesses, the nature of which is fluctuating profit. The earnings in some year will be high, the earnings in the other year is going to be low. Are you getting it? Whereas some businesses are such where they will have large profit and regular profit they are going to earn. So, as simple as that, a business firm which is having which is going to earn regular, the nature of business is such that it's going to earn profit regularly and also high profit, it can easily borrow more debt, because it will be easy for it to repay the installment of the loan. Okay, it will be easy for it to pay the interest on the borrowed funds, on the loan regularly, because it's going to earn regularly and the earnings are going to be high. On the contrary, a business which whose nature is such that the earnings are of fluctuating nature. So in some years they earn high profit, in other year, next year their profits are low, next year there's loss. So things are unpredictable. The profit is unpredictable. So for such a business firm, it's not sensible to borrow too much of debt, because in the year of low profit or loss, it will be tough for such a business to repay the loan, or loan installment, or pay off the interest on the borrowed funds. I hope this is clear. Then fourth factor, children, is capital market conditions. Children, in class 11th, you have done the chapter on stock exchange, in which you covered um, two kinds of speculators. One was bull and the other is bear. Uh, Based, if the market is dominated by bulls, we say that the market is bullish. Okay, the market sentiment is that the investors are willing to take risk, and therefore they will go in for equity shares. So when the capital market condition is bullish, when the market is bullish, we say that will happen generally in the case of boom. Okay, the phases of in the phases in the economy: boom, recession, depression. So during boom, that is prosperity, when the market is bullish, people are in a mood to take risk. Hence, a company can take advantage of this situation by issuing equity shares. It is the equity shares are going to be sold easily. Okay. Now, then comes another phase when the capital market is bearish in nature. It's full of bears. That you already know in class 11th, what is taught in stock exchange chapter. Bearish market means that the people are not in a mood to buy, but rather they want to sell off whatever securities they have. But in short, we can say that during bearish market phase, the investors are a bit on the defensive. They want to play it safe. Okay, so they would like to prefer safety of investment, which is present in preference shares and debentures. Hence, when the market is bearish, the company should issue preference shares and debentures. I hope it is clear. So, in short, when the capital market is bullish, the company should issue equity shares, and when the market is bearish, the company should issue preference shares and debentures. We proceed further. fifth point, it's related to that only, the previous point, needs of the investors. So investors are of two types basically. One investor is a risk taker, adventurous, dynamic investor. We call such a person, such an investor who's ready to take risk. So the company should issue equity shares to enable such investors who are risk takers to invest money in the company. Okay. And then on the other hand, you also have investors who are cautious and conservative, who are afraid of taking risk. They want safety of investment. Okay. Uh, Preferentials and debentures, which are safer securities, they attract such investors who are cautious. So, in short, what does it mean? We come to the conclusion that uh, a company should not only cater to the needs of one kind of investor. A company should uh, try to make different kind of investors, whether it's dynamic or cautious, invest in it. And how is that possible? The company should attract dynamic investors who are ready to take risk by issuing equity shares. And then, what should the company do to attract the investment from cautious investors, conservative investors? The company should issue preference shares and debentures. By doing so, the company will be able to enable both the kind of investors invest in the company, and therefore the company will be able to collect larger amount of money. So that was it for today. I hope it's clear. And in my next class, I'll be discussing with you children factors affecting fixed capital. That again is an important question for the boards. I hope it's clear. Okay. So work hard, be focused, don't waste your time. All the best. I conclude with that.